Investing in the stock market can be a highly rewarding experience, providing a path to long-term financial growth and stability. However, for new investors, the complexity of the market can be a daunting prospect. The sheer number of companies and industries to choose from, combined with the constant stream of financial data and market news, can make selecting the right stocks feel like a Herculean task. But worry not, dear viewer. Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. In this video, we will take you on a journey of discovery, providing you with the essential best practices for selecting the perfect stocks to boost your investment portfolio. Through insightful analysis of companies' financial health, we'll guide you in identifying the key markers of a stable and growing organization and empower you to navigate the often turbulent waters of market trends and shifts. Whether you're a seasoned investor or just starting out on your investment journey, this guide on how to pick a stock, the Ultimate Beginner's Guide, is a must-watch, offering valuable tools and tips that will help you to make informed decisions and build a successful investment portfolio that will stand the test of time. 7 things all beginner investors should know. Selecting the right stocks to invest in can be an intimidating process, especially for newcomers to the stock market. The sheer number of options can be overwhelming, with 11 different stock market sectors, 69 distinct industries, and over 8,400 stocks across the 3 major U.S. exchanges to choose from. With such an abundance of choice, it can be challenging to identify specific stocks that are primed for success. While there is no surefire formula for success in the stock market, investors often use various philosophies, schemes, strategies, and mindsets to approach it. Whether you're a novice investor dipping your toes into the stock market waters or a seasoned veteran looking to revamp your investment strategy, it's essential to have a solid understanding of some fundamental principles before selecting the right stocks. With this in mind, we've distilled down the key takeaways to 7 essential things you need to know before diving into the exciting and sometimes overwhelming world of stock market investing. So buckle up and get ready to learn the tips and tricks that will help you navigate the market with confidence and success. Number 1, understanding the challenge. If you're hoping to become the next stock market sensation like the legendary Warren Buffett, it's crucial to first have a firm grasp of the playing field and the odds stacked against you. Picking individual stocks can be a high-stakes game that requires you to bet on your ability to outperform the market and earn better returns than the overall stock market. But the sobering reality is that beating the market is an incredibly daunting task that even the majority of professional fund managers can't accomplish. Surprising as it may seem, retail investors have fared even worse, with the average investor earning just a meager 3.6% annually, barely keeping up with inflation. In fact, overtrading and making emotional investment decisions have been the biggest stumbling blocks to achieving investment success. While it may not be the most exciting of the 7 essential principles, understanding the difficulty of beating the market and the value of low-cost index funds can be the foundation of your long-term success as a stock market investor. Number 2, outlining your goals. If you're determined to pick your own stocks despite the intimidating odds, the first step is to have a clear understanding of your investing goals. Whether you're a young, ambitious investor seeking high-risk, high-reward opportunities, or a more conservative investor seeking to play it safe and earn steady income, defining your goals will help you focus on the specific stocks that will suit your portfolio best. If your goal is to accumulate a multi-million-dollar portfolio by the time you're 40, you'll likely be drawn to growth stocks or contrarian names. But if you're seeking to play it safe and earn some income, you may want to focus on blue-chip companies, dividend stocks, or real estate investment trusts. However, if you're aiming to be a short-term momentum investor or chart trader, this piece may not be relevant to you. Number 3, understand the business before you invest. Investing in a stock means owning a piece of a business. Just as you would thoroughly examine the financials, risks, and opportunities of a local small business before investing, you should also do your homework on a stock. Investing legends like Warren Buffett and Peter Lynch have stressed the importance of understanding the company you're investing in, with Lynch famously advising to only invest in ideas you can explain with a crayon. By doing your due diligence and taking the time to understand the business, you can make informed decisions and increase your chances of success in the stock market. Number 4, evaluating stocks, understanding financial ratios. Once you have identified your investing goals and found a promising business that you understand, your work isn't done yet. You also need to determine whether the stock is worth buying at its current price. One way to do this is by using financial ratios, which compare the market value of the stock with various figures from the company's financial statements. Well-known examples of these ratios include price earnings, price sales, and price book. Other ratios can also provide insights into company's ability to pay its debts, profitability, and efficiency. While you don't need to analyze every single financial ratio before investing in a company, it's important to understand the key ratios and how they compare to industry peers. You should also be aware of the direction these ratios are trending to help you make informed investment decisions. Number 5. Beware of deceptive temptations in stock market. The stock market is a tricky place where investors can fall prey to many deceptive traps. One common pitfall for new investors is getting drawn to stocks with alluring valuation metrics, particularly the price earnings or PE ratio. However, low PE ratios in cyclical companies like home builders, automakers, and banks can often be a value trap. These seemingly cheap stocks may indicate that the earnings cycle has peaked and future earnings will be much lower. Similarly, investors should be cautious of high dividend yields, which can be a red flag for unsustainable dividends or a significant drop in the stock price. While a blue-chip income stock may pay a decent 2 to 4% dividend, stocks offering a meteoric yield of 7% or more could be a sign of trouble ahead. Number 6. The importance of moats in stock investing. If you're looking to build a portfolio that you don't need to keep a constant eye on, then it's important to pick companies that have sustainable competitive advantages. Investing legend Warren Buffett refers to these advantages as moats, and they're what help protect a company's profits and growth over the long haul. A wide economic moat can help ensure that a company continues to thrive and maintain its margins for years to come. Companies like Coca-Cola and Apple have some of the strongest moats out there. Coca-Cola has its globally recognized brand and distribution network, while Apple has its enviable brand, network effects, and high switching costs that keep users loyal. The strength of a company's moat can have a significant impact on the price investors are willing to pay for its stock. The wider the moat, the more valuable the company is considered to be. So when it comes to stock investing, it's important to pay attention to the size and sustainability of a company's moat to make informed investment decisions. Number 7. Understanding and confronting systematic risks. In the stock market, external factors such as inflation, war, and soaring interest rates can affect your portfolio even if you own well-chosen long-term stocks. While there is no way to eliminate broader market risks, you can lessen the impact of company-specific risks through diversification. One way to confront systematic risk is by purchasing stocks with low correlation to the market, known as low beta stocks. Beta measures the volatility of the broader stock market with a standard value of 1. Stocks with a beta below 1 are less affected when the market rises or falls, making them preferable during bear markets. In contrast, high beta stocks move more sharply, making them better for bull markets. Understanding systematic risks and selecting low beta or high beta stocks can help mitigate the impact of external factors on your portfolio. A 5-step guide to pick stocks. While it may be tempting to train a chimp to throw darts at a newspaper in order to randomly select stocks, there are more reliable methods for picking winning investments. Fortunately, as an individual investor with a long-term horizon, you possess a unique advantage over Wall Street's often short-sighted approach to investing. While the chimp may achieve some success in randomly selecting stocks, relying on such a method lacks the rigor and strategic intent necessary for investing success. By contrast, individual investors can research stocks and analyze trends, enabling them to make more informed decisions about their investments. In fact, long-term investors may outperform their short-term focused counterparts due to their ability to weather market turbulence and capitalize on market upswings. By being patient and strategic in your investment approach, you can capitalize on your unique advantage as an individual investor and potentially achieve significant long-term gains. Number 1. Investment goals and stock selection. Every investor has a unique set of financial goals that drive their investment decisions. These objectives often depend on the investor's age, risk tolerance, and investment experience. For instance, younger investors tend to be more interested in achieving significant portfolio growth over the long haul, while older investors prioritize capital preservation, especially as they near retirement age and plan to draw on their savings. And then there are investors who are more concerned with generating regular income from their investments, seeking reliable dividends and distributions. It's essential to take some time to consider your investment goals before diving into the market. Regardless of your age or financial position, There are no hard and fast rules on what your goals should be. You might be in your 60s and still seeking portfolio growth, or you could be in your 30s and prioritizing investment income stability. Knowing your objectives is crucial since it guides which stocks you will buy. Investors looking for income will search for stocks with attractive dividend yields and strong cash flow and earnings to support them. On the other hand, those seeking growth may be more inclined towards younger companies with promising revenue growth, even if their earnings are less stable. Meanwhile, investors looking to preserve their capital value will gravitate towards established companies with a long track record of steady and predictable profits. Number 2, look for companies you're more familiar with. When buying a stock, you become a partial owner of a business. Would you take ownership of a company you don't understand? Even with great management, how will you know they're doing a good job? Start by considering the companies behind the products and services you use every day. Also, think about the indirect impact of companies you may not interact with directly. You can research different sectors and competitors by examining these companies. If you don't comprehend how a business makes money, do some research or look elsewhere. Number 3, importance of a sustainable competitive advantage in stock picking. To succeed in investing, you need to find companies with sustainable competitive advantage, or what Warren Buffett calls a moat. A wide and strong moat will protect a business from competitors and deliver rewards to investors. The sources of a moat can include scale, switching costs, unique brands, intellectual property, and the network effect. Understanding these factors and how they apply to the companies you're researching is crucial in selecting stocks that will deliver long-term gains. So before investing in any company, make sure to assess the durability of its competitive advantage. Number 4, evaluating stock prices. Metrics to consider for value investing. To be a successful value investor, it is crucial to assess a company's competitive advantage, but equally important is understanding the stock price. There are many methods to evaluate a stock's current price and determine whether or not it presents a good value. Below are several metrics that you can use to assess the stock prices. Price-to-earning ratio, or PE ratio, is a common metric that compares a company's share price with its earnings per share over the past year. This metric works best for well-established companies with consistent profits and growth. A stock trading below its historical average PE ratio may indicate a good value. However, a higher PE ratio may be justified if earnings growth is expected to accelerate over the next few years. The past can only provide a rough guide, as stock prices are determined by future expectations. Prices to sales ratio, or PS ratio, is a metric used for growth stocks that don't have consistent earnings or aren't profitable yet. It is useful to compare a company's share price with its revenue per share over the past year. When comparing to historical averages, it is important to consider the future expectations of sales. Also, it is essential to consider the quality of sales, which can differ significantly from the core business. Discounted cash flow modeling is a highly detailed metric that requires a deep dive into a company's financials. This method involves projecting revenue growth, profit margin, and other expenses for the next several years. Then, use those projections to create a model for future earnings and estimate the stock's value. To determine a reasonable stock price, discount those cash flows by your required rate of return and divide the result by the number of shares outstanding. Dividend yield is an essential metric to consider for investors looking for income. If the dividend yield is higher than the average, it may indicate a good value for the stock. However, investors should be cautious of yield traps where the dividends are unsustainable. Therefore, it is crucial to check how safe the dividend is, based on a company's payout ratio as a percentage of earnings and free cash flow. Also, make sure to check that earnings and cash flow are sustainable and growing. By projecting dividend growth over the next few years, investors can even develop their dividend discount model. By considering these metrics, investors can get a better understanding of the current value of a stock and make informed decisions about whether or not to invest. Number 5, buying stocks at a fair price. Finding good stocks to invest in can be challenging, but the real test comes in knowing when to buy them. The last step in the stock picking process is to buy companies trading below your estimate for a fair price. This is where the margin of safety comes in. By buying shares at a discount, you can prevent big losses if your valuation turns out to be incorrect. This strategy has been a key to Warren Buffett's success as an investor. When investing in a stock with stable earnings and a strong outlook, you may not need a wide margin of safety. Subtracting 10% from your target price should suffice. However, for growth stocks with less predictable earnings, a wider margin of safety is advisable. Aim for 15 to 30%. depending on how confident you are in your valuation. This ensures that you are protected in case the company faces unforeseen challenges or new competitors enter the market. It's not necessary to get the absolute lowest price for a stock. Trust your research and analysis, and when the price seems reasonable, take the plunge. By following these steps and building a diversified portfolio of stock picks across various sectors, you increase your chances of finding winning investments. So go ahead and invest with confidence. And there you have it, folks. With these 7 essential principles in mind and our 5-step guide to picking stocks, you're well on your way to becoming a savvy investor in the exciting world of the stock market. Remember, investing can be a rewarding journey, but it's essential to approach it with discipline, patience, and a long-term perspective. Keep learning, keep researching, and most importantly, keep investing in your financial future. Good luck and happy investing.